I'm going to the city and I'm gonna do a silly show. And I know all my fans wanna learn how to make some dough. I've been cruising up and down for trades each and every night. And with my iPhone reclining, I know we're gonna get it just right. I'll get inside your mind, we'll have a real good time. We're gonna trade today, we gotta trade today. Go askSlim.
Hi, I'm Steve Miller. Call me Slim. And this is the askSlim Market Week. It's a look back at what happened in the financial markets in the past week. And a look forward to what might happen in the next week. Hopefully, lots of great ideas and opportunities for you throughout this show. Well, the stock market edged slightly higher last week as hope for an economic recovery after COVID-19 ruled the day. News that Russia had a vaccine sent the market up overnight on Tuesday, even though they had bypassed the normal testing and no idea about the efficacy of that vaccine, and there are a lot of doubts out there whether or not it's any good. Not to be outdone, the U.S. came on the next day and came out and gave a $1.5 billion contract to Moderna for 100,000 doses, and that did send the market up again. Though Moderna, they still don't have any vaccine. They are in final stage trials of it, but again, while it had some positive results, nobody knows the efficacy of that either. Economic data around the world was awful. The UK had a 20% drop in their GDP, and that's the worst of all countries for the second quarter. And we have very weak economic data out of China and the EU. US, not a whole lot better, as the pop in retail sales we saw the month before stalled, and there was only slight gains in retail sales in the last month. And US claims for unemployment, well, they fell to below 1 million for the month, but that's no reason to celebrate, as before COVID-19 came, the record was up about 695,000, so we are still well into territory of an extremely weak economy right now, and any conversation about any V-bottom or bounce is way out of line. Inflation, though, that's picking up quickly. The CPI and PPI both up about 0.6%. Still, year over year, those numbers are weak, but this is a big decline, a big advance for inflation 2 months in a row. And there is a changing tone as inflation does show, as the U.S. floods the market with new paper. Investors clearly rejected stepping up to buy it, and the bid to cover for the 30-year, which came out this week, was a measly 2.16 to 1. That's the worst 30-year auction in 15 months, and one of the lowest bid to covers ever for that auction. Our analysis shows bond bull is grinding to a halt, and we think that rates are going to start moving up. And that's scary for the markets in this kind of environment, as we actually think the low for the rates is in for the year and maybe for all time. For the stock market, there's a change afoot. Even with Apple making new highs, the techs and the stay-at-home stocks are showing some weakness. The Dow Jones Transportation Average, however, we had an 11-day in a row gain. That's the best performance for the transports in 10 years. As beaten up stocks, and we'll call it the old economy stocks, have started to move up. I'll call it the end of the liquidity trade. That's the stocks moving up because of the Fed and the government putting in this massive liquidity, and the beginning of the recovery trade, where investors start to look for beaten up stocks that are kind of old recovery, old market stocks that would then go up because they look cheap. They look like there is a lot of value in there. I'm going to switch over to another chart right now for you to see, which I think makes the case of what I'm talking about here. And that is a chart that is pretty custom when you look at this. Here is that chart I'm going to show you. And this is actually two charts. And the one on the left is the tech heavies versus the S&P 500. You can see the list of stocks made up in this custom index that I created. And here you could see the stay-at-home stocks versus the S&P 500. And these are the stocks that I actually covered over the last about a month or month and a half twice about the extreme valuations in there. I'm going to blow these up so you can get an idea as to what I'm talking about. Here is that custom index looking at Facebook, Apple, Amazon, Netflix. You could see the list there of stocks that are made that make up this custom index. Here's your high back over here on July 13th. And this is the S&P 500. So while the stock market has been moving up pretty significantly, still as it now moves up towards the old high, you could see that these stocks right over here, the heavyweights in the tech category that have been lifting the stock market, have stalled. And the high was made, well, almost about a month ago. So these that were the leaders of this big upside move in the stock market that we see here from the March lows, they are clearly stalling. Through this whole time period here, they've been the leaders, and now they are stalling. When I look over to the other chart, these are the stay-at-home stocks. These are the stocks that have done so well that are crazy valuations. And they actually did a little better. You can see that they made their high over here. Here's that high where the NASDAQ made its high at this date. And the stay-at-home stocks, well, they started to run past those levels. But now, while the S&P 500 is moving up towards the all-time high, you can see what's going on right over here in these stay-at-home stocks. These are Etsy, Wing, DocuSign, Shopify, Datadog. You can see all of these in here. These are the stocks that mostly are valued at extraordinarily mind-blowing, ridiculous levels. That if there is ever a recovery and we go back to any normalcy of what we had in the economy and people start actually going out and can actually work in a work environment versus at home, well, these stocks are going to be gone. They're going to collapse. And in the meantime, it looks like there's a relative strength change, and these stocks, which were so strong, now are essentially stopping. And you can see that in here in both of these in custom indexes that we prepared, that there is a significant weakening going on. And the question is, can these the switch over that we're seeing right now really be able to hold the market up? This is investors thinking past the liquidity trade and starting to think about the recovery trade. And I think this chart is proof of that. So the big question is, can money flowing out of stocks with stupid valuations support the old economy stocks? Now, those are huge, heavily weighted cap stocks that have been solidifying, that have been getting killed. It's companies that are very badly damaged, most of them losing money, some in such bad shape that only the government, the taxpayer bailout, is keeping them from rigor mortis. The battle over the stimulus is going on, and with signs the government is stingier. The Fed won't be able to borrow as much as they have. Basically, what we're seeing, these vast sums being rejected by investors as the bond market falls off sharply and interest rates pop, based on the huge amount of borrowing that's going on. So with the government now gone until September, of course they're going to be trying to put something together while they're away, some negotiations, and they're clearly them very far apart, and the Fed having a hard time borrowing. We think that it is really a time when the liquidity trade is certainly in question. And without major disruptions to the bond market, without the ability for the Fed to borrow that much money, investors are likely to get pretty uneasy with all of that going on. We've talked about a correction now for 2 months, and it hasn't happened yet. And certainly the market has extended well beyond the time that we thought would be normal. Next week I'm going to bring you a chart that shows the highly likelihood of a market correction. I brought those to you before, and so far that hasn't been right. But we're going to say right now, the sum of the evidence, based on everything I just showed you, is that it's not very far off. And we'll talk about that a little bit more as we get into the end of the show. For the week, the stock market overall up small. Dow Jones up about 1%. It's the best of all the major indexes, except the Dow Jones Transportation Average. Those are the recovery stocks I'm talking about. 4% gain on the week. A ton of buying coming into them because, well, they're starting to try to put money in somewhere where maybe they can make some gains again. They're, that old searching for alpha. Well, that's what they're trying to do when they buy these zombie stocks or stocks like the airlines that, are destined to lose money for who knows how long. The bond market, 30-year down 3 points, a pretty sizable decline, and a sizable 13 basis points gain for the 10-year. It was a bad week for the bond market, and clearly investors have no interest in a 30-year bond at 1.39%. Huge tail, very, very bad bid to cover, as I said, and there is a sign of something. Gold market suffered from that, but it was had a giant rally. It was a $96 decline here at midday on Friday for the week. The range was huge, $187 range. Silver on a percentage basis, even bigger than that, loses about $1.60 on the week with a $5.80 range in there. That is absolutely huge for the silver market. We actually think, and watch our Future Speak show on Wednesday, we talked about the patterns in there that are suggestive of, well, maybe there's not a lot more upside coming in the intermediate term. The dollar down about 0.3%. And it's in a minor rebound phase, and we don't love the dollar, that's for sure. It's in our short-term view also, and we'll be bringing you some information on that. And the oil market up about 50 cents on the week in a very, very tight range. That's the opening of the show. I want you to go to askSlim.com. Go there, explore the site, see all the things we bring. And if you're watching this on YouTube, subscribe to the channel. Click on the notification bell, and you will be able to be notified when we put up one of our many videos that we put on YouTube. And certainly give us a thumbs up, like this video if you do like it. Follow us on Twitter at askSlim. And if you want more information about our site and services, memberships, please do write to Matt at askSlim.com. Matt is our COO and one of our great analysts here at askSlim.com. And you'll find him fascinating to communicate with. So write it, Matt at askSlim.com, for more information. All right, so we're going to make it a little bit of a shorter show today, as we're going to jump into the short-term view right now as we look at the 5 major markets that we look at. And this is always about how did we do the previous week, because we want to make sure that we are accountable to that. So we had a pretty good week. We were better than 65% correct. We had some small misses in there because some of the intensity of some of the moves were not perfectly right. For example, for the S&P 500, we get a lot of credit for that because it missed but it missed the downside. It didn't fall as hard as we thought, but the shape of everything was correct. Similarly, for the bond market, it didn't quite make it up as high before it failed as we thought. We got the dollar pretty much spot on. Gold market, we're going to take a little dinger for that because it fell a little lower than we expected, but perfect in there also on cycle analysis and shape, and similar for the light crude market. So let's get into that as we now look at our charts. I have SPY up, but that's not what I wanted to show you. We're going to get to the light crude market right over here. and look at the daily chart. So here is the daily chart of the light crude market. What we see now here, and I'm just going to bring this in a little bit tighter so you can get a better idea of the market right over here. We'll just grab this right here and right here, get a real tight look. There you go. So you can see in here, I don't even like that look. How do you like that? Well, we're just going to start that over again and look again. There we go, that's better. So what we have in here are the cyclical patterns. Remember, we're cycle analysts. We look at the rhythms of the market, the heartbeat of the market. And each of these on the bottom are called cycle brackets. They line up with key lows that you can see over here or you could see over here. That is how we see the rhythms in the market. We also look at the upward momentum or negative momentum, if it be the case, and we bring in some other indicators and do swing high, swing low analysis to come up with support and resistances. That's basically the core of the work we do. We use the projection oscillator along with the slim ribbon as confirmation to the type of moves that we see in here as far as the momentum conditions. Momentum in here still on the upside. You can see the triangular shape forming in here, but there's a cycle that looks like it's going to come down. So what we're looking for over the next 2 weeks is essentially a failure, and we're looking for a move to the downside. This is around $41 right in the middle here, 41.10. This is about 40.60 right over here. This is about a week and a half's time in here, and then moving up after that again. So you could see this kind of gives you a probability that it will try the upside again once and then move down, but it doesn't really have to do that. It's about 2 to 1 probability it will try the upside first and then fail and then move down, but basically we really see a range. Overall, not a lot of upside and not a lot of downside. We talked about a range last week, and that range was about 44 to 38. We're tightening it up a little bit now to about 43.5 to about 38, but that's over the intermediate term. Some of the evidence really is that it's still stuck. We don't see any giant moves in here, but there are bigger risks into September. And this cycle right over here that we're looking at, this one really is the one that says to us that there is more risk, and we're looking for the potential of getting down below 38, maybe 36.5 during that period. But again, there is not a lot of energetic movement in here, and we just might not be able to get that kind of range forming in here. It will take a tone change to get that. So next couple of weeks, we're looking for kind of maybe a little breakout on the upside, but not getting anywhere and really getting down to this area of 41 to 40.60 in the light crude market. The next thing we're going to look at is the gold market, /GC. Very interesting chart in here. As we bring that up, and we're just going to tighten this up again for you to see. Now, we did AskSlim Live last Tuesday, and we showed in here and in Future Speak on Wednesday these two different tracks. Now, I'll tell you a little bit why we have that in here. Now, under the condition of this cycle right over here, if it had stopped somewhere right over here, then this would have been the normal movement right there. But because it got down here to the 78.6%, this is a lot of what I teach in the cycle workshop, it then lowers the potential for the track. So we put in this resistance right in here. And what the odds are, the highest odds, are that the lower track is what will play in here, and that this low that it made at 1875, which is quite a bit lower than we had anticipated, is very likely to get tested or broken out over here. So what we're looking for is a little bit more rally, and this is kind of a 2-week period here also. A little bit more rally, get maybe a little bit further up into here. This is this resistance right over there is around 1980. This is about 2005. 1980 is a pretty reasonable target for the upside in here, and then failing and moving back down, 1875, 1830. Those are really the numbers that we're looking at in here. These are off of the intermediate charts. So we don't think that there's much upside in here right now. Momentum is still strong, and we're getting a little buy in here, but you could see it weakening in there, and it is losing its upside momentum. As a matter of fact, it looks like it's going to neutralize for the first time since the third week of June. Now, were that to happen, I mean, it would really confirm that this upside is quite limited and the odds of getting under 1875 will increase. So this is all a short-term view within a longer-term perspective. Intermediate, we think that all of this is making a top. And so the sum of the evidence is that between this intermediate, the intermediate affecting this in a negative way, and the silver correction, which we think is here, I think that's going to weigh on the metals sector, and that we're likely to get this period over here out into late August, and then further out over here as periods where the gold and silver market are going to be in a pretty wide chop and not taking out new highs and not giving up a ton of room, but just a very wide tradable chop is what we see there. So again, for the next 2 weeks, we're looking for a failed rally, maybe up to that 1980 area to just around 2000, and then falling back and getting down to these support areas down over there. So that is a look at the gold market. Dollar sign DXY, you could see that right here. This is the dollar. And the dollar, we had talked about the bottom, a little bit of a bottom forming in here, an attempted rally up to this area about 94.40. The bottom is formed in here. The momentum clearly still negative, as you can see. The sell signals coming in here, and this really looking to me like it's going to be tough for it to get up here to 94.40. We still think it's a possibility, but it is really struggling here at this 23%, as you could see, and it's possible that this area just over 94 is about the best it will do. We'll give it credit for trying again up over here. So we see negative momentum still. We see this big resistance zone here and struggling down over here. It doesn't allow for much upside is what we see. So for the dollar over the next couple of weeks, we see some minor chop in here trying to get up. We don't see a lower low, but if it does, it's going to be a really bad message. And if we're right and this tries to get up over here, that's going to be in line with maybe some struggle for the metals markets that we're talking about. Some of the evidence here in the dollar is that momentum is negative in all time frames. The uptick in rates that we see is helping in a small way right now, and especially against the Japanese yen, which has now become the weakest of the currencies. So the dollar could get a little bit more footing in here, but basically it is a very big downtrend, and this is simply a bounce in a very big and strong downtrend in the dollar. All right, the next one we're going to go to is the bond market, which is /ZB, as we look at the 30-year bond, which I said had done so poorly as far as their ability to sell the bond. I'm showing you two harmonic families right in here. As you could see, the dominant cycle right there and the minor thirds right in here, which are very clear right there, and the minor thirds in here, which are also very clear. Let's get a look at this right over here, tighten up right there, and you'll be able to see, well, we talked last week about the likelihood that the bond market was going to try a little upside and then move down. Our target was to get up around the 83.20 area and fail. Well, it didn't get anywhere close to that. The high for the week was right over here around 182, right over here, 182.28. So it didn't have one more little pop as we suspected, and the weight of these two cycles pushing down, well, you can see that, and it certainly did not help the fact that they had a very hard time selling this bond. So we had talked last week that we thought it would try a little upside and then move down. Now what we see in here is probably a decline into the midweek area still, and it's in this support area that comes off of the weekly chart, so it's an important support area. Down at the bottom of this is about 176.26, and then we see it trying to move up again right in here. So this probably is in alignment with a flight to safety if we're right about the stock market going into a corrective phase, which we spoke countless times about. And this probably is going to be some just minor weakness in here and then trying to move up again for the bond market. There's a lot more risk out over here. As a matter of fact, the date that I'll assign for the big risky period is a low that moves out into October, that you could see that date right there. So that's a look at what we think in the bond market. Some of the evidence in there is there's likely a major bottom in yields that has been seen. That means a major top in the futures, and we think that the Fed is losing control of the long end because of the massive borrowing, and we're just at the very beginning of that potential. So that's a look at the four major markets that we look at, and we're going to look at the market pretty soon in the S&P 500. But there's something that I have to show you right now that I think is incredibly important. Look at this. This is the stock index report from yesterday. This is our live stream. You don't need any kind of a special platform from this. So I took a picture of yesterday, and I'm going to show you today also. What this does is give you short-term analysis on the S&P 500 and the NASDAQ and the Russell. You get key important levels of resistance. You get key important levels of support. And you get acceleration zones where that helps you make the bigger trades, where there are essentially voids where it moves down strongly through. So you could see the importance of the resistance level right over here. You could see the importance of the support level right over here, and the quick move down through that acceleration zone for the S&P 500. Here it was a little bit different in that it didn't make it through the acceleration zone. The probabilities are small of that, but found the support where it's supposed to right here, and found that support also right over there. So you also could use this for pair trading, because it becomes very clear which are the strongest and which are the weakest. You could see right here where the S&P was moving down. This is the reversal scout, which gives you a good sense of directional movement. Here, at the same time, the NASDAQ was moving up. So if you were a pair trader, you would be short the S&P and long the NASDAQ, and you would have a beautiful pairs trade that lasted, well, for a couple of hours time in there. So, of course, that's for very, very short-term trading. I want to bring in the live one that's going on right now that you can see. And this is actually the same thing, but this is live. For our level 4 members, you get a link. You can put this right on your Thinkorswim platform. Or for all of our level 2, 3, and 4 members, you get a link in the morning, and you can just use this without the Thinkorswim platform. And this is live right now. You can see what is going on today, and that is the market was moving down. The S&P 500 found the strength right at the support and then turned up. It couldn't quite get to the resistance, and it's moving sideways. Here you could see the NASDAQ through the acceleration zone, hit support, and then turns up. And you could see the upward turn right over here. And here the Russell hits support on the money and then turns up at the same time. So what you have going on here is a sign that, well, the market has, basically made its low for this duration of time and is turning up. And you can get a pretty good feel for where the support and resistances are. It's been a rather narrow range today, so there's not a lot to see other than the high quality of the support zones that you could see there in all of them. So beautiful information that you get in here every day. This, as I said, is live right now, and you're watching it live. And this it would be available to you as a level 2 member, or level 3, or level 4. Level 2, well, what do you get in that? Well, you get the live stream with no platform available. You also get our stock index report, which comes out daily, which gives you just a fantastic amount of information on all of the 3 indexes, just great technical information in there. You get our weekly stock index report. You get our weekly ETF report. You get the Slimulator momentum tracker, which is more than 1,000 symbols that puts all of our output in there of all of the momentum analysis that we do for short-term, intermediate-term, long-term. You can do all kinds of sorting in there and all kinds of searching, and we have pre-programmed groups. It's an amazing app that you get included in that. And our whole video library, over 500 videos in 9 categories. There's so much you will learn from me. I created all of those videos, believe it or not, and you will learn from me. How about all of that I just showed you, the live stream, all of that, $45 a month. And if you sign up quarterly, you get a discount on that. It's just an amazing value. Less than $2, or no, a little over $2 per trading session. And for all of that information, you could binge watch all of those videos. Amazing. Write me at askSlim.com if you want more information or a demo sent to you. $45 a month. How can you not sign up for this? I have no idea. Please do. And again, if you want more info, write Matt at askSlim.com, or else just go to askSlim.com, go to the membership on the main page, scroll down a little bit, and sign up for levels 2, 3, or 4. Everything that's listed that you get in each level is right there on the website. Just absolutely amazing stuff. And get that. If you're a short-term index trader, you're just going to love it. People love our stock index report, both the live stream and the daily. All right, so now we're going to get into what you've been waiting for, which is the look at the stock market for the coming week. All right, so here we go. We're going to look at the S&P 500. What I said last week was that I thought that there would be a dip into the early part of the week and the market would rally. Well, the NASDAQ had the dip. It was pretty readable in the NASDAQ. You barely got anything down over here. This is one of the strongest cyclical formations I have ever seen. Just amazingly strong. Here you could see the rhythms in the market. I have the Apple and Facebook have different cycle patterns. I put it in there just so that I could see how they are affecting the market. That's the green one you're looking at right there. And we are in day 3 of this upside move right over here. It's actually, when you add all of this up, this was a 20-day high, 20-day low. This almost never happens. As a matter of fact, there are a few times that I can track when it happened, and generally what happened was the next cycle was pretty short in duration on the upside and then turned down. This lines up with what we're looking at in the intermediate, lines up with the NASDAQ and the Russell for this corrective process we're looking for. The window for the correction is really shortened now to about 3 more weeks. In there, if it were in the normal time frames, we'll assume it's going to be close to that. So what are we looking for in this next week? Well, we got the little dip, we got the rally, and the NASDAQ was, as I said, several days in here on the downside, far more recognizable than what you got right in here. And that's because of the selling going on in those liquidity stocks that we talked about. And the money moving into the old economy stocks is keeping this stronger. That's what's going on. We'll look for a slight all-time high. That is the highest probability. Here's that line coming across the top of the fib extensions. There's your slight all-time high that we think we're going to be able to make, and then rolling over and going into the sizable correction. 3326 on the S&P 500 is the important level. That would be the breakdown right over here. That would coincide with a similar breakdown in the NASDAQ, I'm sure. And that's the key number we're looking for. It's only about 50 points away, and we think the probability of it going through that number in the next week is not real high, but in the following week is very high. So we'll look for that. That's the key thing we're looking for. Some of the evidence is that all momentum is strong. You could see that right in here on the short term. We have these buy signals continuing. We have a buy pending coming up right over here. So none of this says that it's quite ready to move to the downside, but we're going to look for that all to change. Focusing on this target around 3,100 right now on that 23%. That would only be about an 8% drop in the market, which would be a rather modest correction in here were that to happen. Most people would look at that and say, you're nuts, and the market can't tick down. It certainly can't. Well, I've seen these long upside moves come for many times in my career, and all of a sudden, out of the blue, they just start throwing them away. So that's kind of what we're looking for. And then again, some of the evidence tells us that well, that might be it for the correction were that to happen, looking something like that. So the next 3 weeks, we're looking for a small all-time high, and then rolling down, taking out that 33.26 number, and then getting into a pretty good correction. That is it for the week. Showed you so much in here as we looked at the key custom two charts that I put together that show you that the stocks that lifted the market before are now stalling. I think that's an important aspect of what we looked at in this show. And with the liquidity, with the gold market, silver market, bond market, all saying that the liquidity trade is over, I think that you have a pretty good indication that which lifted the market, the stock market, for this whole period of time is starting to struggle. And that might be the important message for this week. I want you to be so careful. It is so crazy out there. And I'm always wishing you great trading.